Hello and welcome to episode 452 of the Money to the Masses podcast with your resident expert, as always, Damien and me, Andy Leaks. Damien, welcome back. We're here again.
Yeah, it's good to be back. Again, another busy week. And we had the budget last week, but we are now fast approaching the tax year end. So we are going to be doing a tax year to-do list. I best make sure we do it now, I don't forget in the coming weeks, as we head into that tax year end. So yeah, where there's a tax year end, it means a lot of content to write, particularly around ISAs, because things are changing. So yeah, Andy, busy as ever, but it's good to be back.
Good stuff. So before we start with the podcast, shall we start with some positive feedback that we received this week? We were glowing in the office when we received it.
We're absolutely buzzing, and I do say normally at the end of the podcast, so this week we're doing it at the beginning. Please do leave a review, send in your emails. Positive reviews obviously do get the team incredibly motivated, and Andy's going to read one out in a second. So if you can leave a review, please do so on your podcast app of choice, 5 stars only, please. And we may read it out, and if we do, then you could get a Money to the Masses mug. Okay,
so Paul got in touch and he said that I listen every week following your advice and suggestions, and he's now exhausted the bank transfer opportunities. He found it really simple to do in a very simple way of earning additional income, and we'll come on to that a bit later in the podcast as well. He said, I've put money into savings, into fixed accounts, earning a good rate of income, which has supplemented their earned income, and now they're debt-free, paid off their mortgage. The wife has retired, aged just 55, and he's working in an area that he wants to do and plans to stop in a few years' time. So with the guidance of Money to the Masses, I could have stopped now, but he's enjoying what he's doing. So you and your team have helped to make this possible, and certainly they wouldn't be in the position they are without us. So what glowing feedback that is.
It is amazing feedback, and I can't overstate how much of a buzz that gives people in the office, because I do share these around anonymously, of course, and it gives people a real motivation for what we do, because you have to realise we make these podcasts, we make these videos, we write content, and there's not the automatic feedback that you get in most other areas of life. So it's great to have the feedback from all of the millions of people that read the site, but the thousands of people listen to the podcast and watch the YouTube video. So please do write in. It's incredibly motivating for the team. So thank you for sending that in. And as you say, Andy, there was a nice link there to something that's going to be on the podcast. So I'll jump straight into what's going to be on this week's show. There's going to be 3 pieces as usual. One of them at the end is in relation to the bank switching offers that are out there. So I'm going to come on to something new that's happening in that particular area. There's going to be a piece on deferring your state pension. So there's a nice link to, I actually went out to dinner with an old friend this week, and they had actually deferred their pension, and they had deferred it to a point where it was actually double what the normal standard pension is. So it was something that was a good reminder. Not sure I've spoken about it at length before on the podcast, but there's some interesting details in there and the benefits of doing so, and actually when you can and can't. So I'm going to cover that. And the other piece, which is something I think everybody will be interested in, is the level of income you need for retirement. Now, we're talking about a minimalist kind of a retirement and going through to a comfortable retirement. So 3 different types. We're going to cover that. It's based on research that's been released recently that takes into account the cost of living crisis, so how much prices have risen. So be in there, you'll find out roughly the kind of income levels you might need to have the retirement that you want.
Okay, so we might as well start with that piece then. So there's been some analysis that's been carried out about how much you actually need to retire on. Damien, you've got some numbers that you want to go through.
So Pension and Lifetime Savings Association, they crunched some numbers and looked at the amount of income you need for different types of retirement. Now, in the past, we've looked at how much money you need in terms of the pot size, and we've covered this topic in different ways. But the reason I wanted to look at it today is because it's been upgraded for 2024, taking into account the cost of living crisis and the rise in prices that we've experienced. But I also want to look at it because I'm not going to give you a definitive number, but what they have done is come up with 3 different scenarios, 3 different types of retirement. So I want to give people an idea, a finger in the air of how much that they may need. And also it illustrates the point that people who retire on their own, so people who are single, actually on a per person basis need more money than if you are in a couple for the same type of retirement. So you normally have twice the kind of income levels coming in. Now, that is something that we found before we did a piece on the podcast about how people's spending patterns change throughout retirement. I'll put a link in the notes of the podcast for that past episode, so you can see how the spending patterns in retirement do change. But going back to the latest piece of research, now they identified 3 different types of retirement. So there was the minimum retirement, the moderate retirement, and then the comfortable retirement. And I'm going to read through the 3 different types. I'm going to put a link again in the notes to the actual piece of research so you can go and find it and read it yourself. But these are the 3 types. Pick which one that you think you're going to have or what you'd like, and then I'll come back to the actual numbers or the income you need per annum in retirement, net of tax, and that's also assuming you've paid off your mortgage to achieve each one. So starting off with the minimum retirement now. Now this, for a single person, includes an allowance of around £50 a week on groceries and £15 every fortnight on takeaways. It also includes a small minimum budget of around about £100 to maintain your home. It assumes you won't have a car and you will rely primarily on public transport to get around. It also assumes a week-long holiday in the UK rather than abroad each year, and there's some allowances made for birthday and Christmas gifts, but no allowances made for helping out grandchildren. And this is given a title of a frugal standard of living in retirement. Now, if you jump onto the moderate retirement, it assumes you'll spend £55 to £100 a week on groceries with a weekly meal out and a weekly takeaway. I mean, I don't even do that now, but this is the moderate retirement, plus the opportunity to treat relatives to a monthly meal out as well. You might also have a second-hand car that you use and you replace every 7 years, as well as a little more money to spend on taxis and public transport. So you can see where this differs from the minimum type of retirement. Now, on top of that, you'll also be able to spend a fortnight in Europe each year and at a mid-range all-inclusive hotel, as well as up to £1,500 on clothing and shoes per person every year.
Wow, so, that's more than I think that's more than I've ever spent.
I did feel like I was reading at one of those competition prizes on the radio. You get a 4-star hotel and £1,500. So now the moderate retirement also assumes that you'll be able to spend a bit more on gifts, so up to £1,000 a year on supporting family members, such as paying for activities for grandchildren. Now we come on to the comfortable retirement. Now, this assumes you're going to be spending £70 to £130 a week on the food shop, depending on whether you're single or in a couple. You'll also be able to eat out at more expensive restaurants every week, have a takeaway every week, and even treat others to a meal once a week. And you'll be able to afford a second-hand car as well, which you'll replace every 7 years, but you'll be able to have a slightly larger allowance for public transport and travel, and larger allowances for gifts, as well as the £1,000 for supporting family members. So it's just the moderate one, but with the allowances dialed up a bit. And so which of those you would want, or which do you think is more realistic for you? Now go into how much income you need for each of these. Now these are figures that they've calculated. We did actually put this out a few weeks ago on social media, and I did plan to do it on the podcast, but various reasons, budget, illness, all different reasons, I wasn't able to do it at the time. And it caused quite a debate online when we put it on social media, because some people thought the numbers were quite high and maybe slightly unrealistic, but these are just guidelines, okay? So if you're listening to this just gives you a feel. So for the minimum retirement, if you're single, then that's £14,400 a year in income you will need to have that type of retirement. If you're a couple, it's £22,400 a year. Remember, that's net of taxation, and also it's assuming you've paid off your mortgage as well. So you can see the couple isn't double the single amount, and as I mentioned before, that's because the amount of expenses aren't double just because there are 2 people. So the moderate type of retirement, if you're single, then they price that as £31,300 a year. If you're a couple, it's £43,100 a year. And if you're going for the comfortable retirement, then that's for a single person, the £43,100 a year. And then for a couple, it's £59,000 a year. Now, those are the broad numbers. So if you want to know what size pension pot you might need, assuming you've got a defined contribution pension, not lucky enough to have a final salary pension, what size pot you would need to produce each of those incomes, you could use the 4% rule, but go with the 5% rule. So take any of those numbers and then times it by 20. So if you're looking for a comfortable retirement, if you're a couple, then you are looking at in excess of £1 million in a pension pot. So they are big numbers and they can be slightly daunting. But of course, when you look at those numbers, I would argue that they are quite punchy, especially with the comfortable retirement when you're buying meals for other people. Even now, I don't go out once a week for a meal. I barely go out even once a month, but also takeaways, etc. So they give you some numbers to look at and play with. But what I want people to do is take those and engage with them, because these are based on assumptions, but they're not based on your lifestyle, what's important to you. So like I said, I'll put a link in the notes to the piece of research so you can read the assumptions, but I've basically told you what they are pretty much. So you now need to work out. If you're listening to this at the weekend, you're walking along with a dog or something, think about what is important to you and what you'd spend your money on in retirement. So for the comfortable retirement, they're stating that you're going to be needing best part of £5,000 a month. That's quite a lot of money as a couple. If you could work out what your minimum amount that you need based on now, and you could sit there and start to think, well, what sort of numbers would I need in today's money, then you can start to think about the future and plan.
Okay, so as you say, pretty punchy numbers there for the comfortable retirement, almost £5,000 for a couple. Does that include state pension figures as well?
So this is the important point, Andy, is that it does include state pensions. So those numbers there are numbers that are wherever your income comes from. So if it's pension, anything else. So it does mean that if you have a state pension, which at the moment is £10,600, it's going to go up in April, then a lot of the minimum standard of living in retirement for a single person is actually provided for by the state pension. For a couple, it was £22,400, if you remember. Well, if you have a couple who both qualify for the full state pension because they have a full national insurance record, then they will pretty much have that minimum standard based upon their state pension claim. So the state pension is important when looking at these figures. So taking that off, if you were somebody who is a couple, for example, and is $59,000 for the most comfortable type of retirement, if you've got a state pension, both of you are receiving it, you get to retirement age, then you can take the best part of £20,000 off of that number, which would bring you further down towards about £40,000. So you're each having to generate around about £20,000 a year in order to have a very comfortable retirement based upon these numbers. So that makes the pension pot number that you would need at the point that you are receiving your state pension, so state pension age, much smaller than those big numbers that I mentioned earlier. So in this example, where I said you'd have to have, well, if you had a comfortable retirement for a couple, that was 59,000, let's call it 60, then you times that by 20, then you'd have to have 1.2 million. But of course, when you've got the state pension taken into account, and we're looking at the £40,000 number that I just mentioned after allowing for state pension, then that brings that pot size down to 800,000. Still a big number, but it's far different to the 1.2 million. So you can see, looking at all those numbers, they are more manageable, but main thing is, the takeaway is start to think about what your retirement looks like and be realistic.
Yeah, very interesting stuff. So taking that on then and kind of linking two pieces together, we talked about the state pension there being roughly 10,600. It's going up in April. You went out with a friend recently who happened to mention just casually over dinner that they've managed to achieve a state pension of almost double that by doing something. You're going to explain what that is.
So, yeah, this was an interesting conversation, actually. I met up with an old boss, so somebody I worked with before Money to the Masses, actually a few jobs before that, but an incredible guy who I learned a lot about. So you may have heard me talk on the podcast about the days when I used to work with the really high-earning lawyers who earned millions of pounds. Well, it was with this guy that I learned a lot of the stuff relating to the wealthiest people in society and helping them with finances. And it was really the kind of birthplace of a lot of what happened with Money to the Masses, in terms of me then wanting to help the masses out there rather than just focusing on the wealthy. And I've stayed in touch with him over the years, and he's now due to retire. And he won't mind me mentioning his age, but he's now just about to come up to 74. Well, he's actually 74 now. He's going to be 75 in the next 6 months. And he loved his job. He kept on working. He didn't really need to. And as a result, we were just chatting about things, and he happened to mention he is obviously a savvy financial advisor, and he had been working all those years and didn't need his state pension when he actually hit retirement age. So he deferred his state pension. Now, for some people listening to this podcast, you may not realise that if you don't need your state pension, you can defer taking it. And that means that you decide that you're not going to take it, and you choose a date in the future where you then apply to start receiving it. Because when you hit state pension age, you don't wake up and then money starts hitting your bank account. You have to apply to receive your state pension. Well, he decided to not do that and defer it. But there is a benefit for deferring a state pension because it becomes rated higher. So what they do is they lift it up. And when he reached state pension age, it was a crucial date. It was before April 2016. And he ultimately deferred his pension for 5 years. And at that time, for every year that you deferred your state pension, it was increased by 10.4%. So by doing it for 5 years, he effectively increased his state pension entitlement at the point he started to claim it by 50% effectively. And then upon claiming his state pension, it was about the time when we started to see some of the increases in inflation, and obviously you have the triple lock starts to kick in. That actually increased his pension once he started claiming it further, and of course he already had a larger state pension anyway, and so now at this point in time he receives a state pension of around about £20,000 a year, which is a huge sum for somebody who is single effectively. And that number means if you were going back to those 20 times pot, you would need a pension pot of around about £400,000 to try and produce something like that every year to be able to be sustainable for certainly a couple of decades. And so you can see that by deferring, there is a huge benefit to it if you can afford to. So what I wanted to do was talk through it because the rules have changed since he started doing it. So like all things, they do come to an end. Now we have the new state pension. So from April 2016, if you decide to defer your state pension, once you hit state pension age, so you've all got to see when you actually hit it, it's different for different people, but if you hit the state pension age, at the moment it's 66, but that is obviously going up over time, then for every year that you defer your state pension, you get it increased by 5.8%. It's not as good as the 10.4 that I was talking about my friend received, but you get 5.8% now. And it's because what happens is you get the equivalent of 1% for every 9 weeks that you defer. Interestingly, if the reason you defer is because you're in prison, then you don't get that uplift. So that is fair enough. So if you think about it, that increase means that the 5.8% can be rolled up over time once you when you eventually decide to take your state pension. So what does that equate to at the moment? The 5.8% extra for deferring for 1 year, based upon the state pension now, which is £10,600, equates to something like £614 a year. But don't forget, that's every year for good, until obviously the day you die, because when you die, your state pension disappears with you. In April, the state pension is going up to £11,500, so you're going to be increased again. So the numbers I'm using are based on now, but of course the state pension will go up. Now, you get to the point where the increases will also be increased in line with inflation. So there's an increase on already increased pension. The question is, when is it good to defer and not? When do you win? Because obviously you've deferred at the moment, let's say, given up 1 year's worth of state pension that equates to £10,600 a year. You need to live for over 17 years before you are in the money. Because you've given up £10,600, you're only making £614 a year. You do the numbers, it's heading towards something like 20 years. So just between 17 and 20 years, you're going to have to live before you are better off. The decision will actually benefited you. But of course, that's not taking into account any increases in the pension over that time either. So the longer you live, the more you gain. Now, I'm going to put a link in the notes to give you the details about how the deferral works, the sort of rules around it, and etc. But one thing to point out is that obviously, if you defer and it increases your state pension, that's attractive, but that probably isn't the main reason why you would do it. So my friend happened to be a financial advisor. He knows the rules, but also he carried on working, and he didn't need the money. He would just be drawing on it, and like probably many people who may be working, continuing to work, they will be paying tax on their state pension because the state pension is taxable. So if you're working, let's say you could be paying 20% income tax, 40%, or even 45%, then if you added the amount of the state pension onto your other income, effectively you'll be getting that tax. The net amount will be after the income tax. So it makes sense to defer a pension, and you'll win more if you defer it to a point where you pay less tax. So there'll be many people, and this is what good financial planning, this is what happens when you have good financial planning. People would plan their drawdowns on their pensions and investments in line with their tax situation. So people would therefore want to draw on their investments when their income levels are lower. So they maximise their allowances and they don't pay any more tax than they need to. That's just sensible planning. So by deferring a pension, you could actually keep more of it, and it's also increased as well because of the deferral, because you're taking it at a point where you have less income anyway, and you therefore pay less tax overall. So there is an idea that might interest some people. One thing to point out is that if you have already started taking your pension, you can stop and then start deferring it. But you can only do that once, because once you start it up again, you can't stop starting. So it's a decision not to be taken lightly. You might have to do the numbers, and you have to sort of think about, no one knows when they're going to die, but looking at the numbers, think of somebody who hits 66, looking at a time span of 20 years where you might break even. Well, no coincidence, that is the typical life expectancy of somebody who is at retirement anyway. So the one thing also to point out is that this sounds like a good idea, but there are points where it definitely isn't. So if you receive pension credit, then the increase in the pension because of a deferral could actually make you ineligible for those payments. So it could be a hindrance to you, a bad idea. So if you have pension credit, do be mindful of that. Also, you don't get the uplift if you defer if you receive one of a number of benefits, and they include things like income support, employment and support allowance, job seekers allowance, and universal credit as well. So again, we'll put a link in the notes so you can read more about that. But deferring a state pension is a concept that most people never realise you could do. So it's interesting to bring that to the podcast, but also having met somebody who's actually benefited from deferring their state pension. I don't think I've ever met somebody who has benefited to that degree. I think it's something for the podcast for people to bear in mind.
Yeah, and of course, we're not quite at the stage yet where we know whether or not he's truly benefited or not, because he's still got some years to come before he makes it. I don't want to be...
He's a funny guy, and when I was talking to him at the dinner, and I said that to him, I can't believe that. His first words were, Damien, I'm going to have to live to, and he said whatever age it was he had to live to make sure I'm quids in, because the reason he really did it was because it was sensible from a kind of tax perspective. He'd done the numbers, so he's sitting there working out how long he's got to live. And
he's got a clock on his phone that's doing a countdown for him.
He'll be well chuffed with.
He wasn't eating red meat and lots of butter and having a few pints, because that will definitely take a few years.
That was definitely what he was doing. So anyway, it was fantastic to see him, and it's great to always go back and meet people from your past who you've learnt lots from. And I think he does listen to the podcast. So if he is, then I'd say a big hello to him on the podcast.
Okay, so let's move on to the final piece of the podcast then, and it's a short piece about bank accounts and switching offers. So a new offer came out this week from a bank that we haven't seen before. It's a new type of offer, and we wanted to cover it because there's a lots of caveats and a little bit of a nuance in terms of savings.
Well, there are quite a few caveats, and it linked very nicely. I was thinking about doing it on the podcast, and I don't always do these because it can be very time sensitive. Although the deal doesn't have an end date, the way we've seen these things come and go, that they're being pulled all the time, and then new ones added as the banks try and attract new customers. So this week on the YouTube channel, I have produced a video that talks about all the best switching deals. So I'm talking about people who are switching current accounts to a new bank, and you often will get an offer, and these offers vary between about the amount they pay you. At the moment, this one from HSBC is the leader. You can get up to £220. Now, I say up to because there are caveats, and you've got to do something over a period of time. Now, go on the YouTube channel, subscribe to it, because I do these videos regularly, typically monthly, of all the best deals. But this linked very nicely to the kind review that we read at the beginning of the podcast. There are people out there who do use these deals, move around, and they're not playing the system because the banks allow them to do it, but they can make money out of opening these bank accounts and moving money between them to fulfill all the criteria, which typically is that you've got to put a certain amount of money in each month. They just move the same money from bank account to bank account to bank account, and have some direct debits on there as well, and therefore they can get these cashback offers. Now, this week HSBC launched a new deal which is interesting. So you have to use the current account switching service to take advantage of the deal. What that will do is ensure the switch happens smoothly. It will take 7 working days. All your direct debits will go across onto your new account, so there shouldn't be any problems, but if there are, then you won't be out of pocket. They'll also ensure that certain transactions that hit the old account do get moved over into the new account after you've switched, because the old account will be closed as a result. Now, I've got to come back to something on that, so do remind me. The difference with this deal is that you've got to open up a HSBC Advance or Premier account, and once you've opened that, you have to have 2 minimum direct debits or standing orders that put on the account within 30 days. Now, that's okay, that's something quite standard. People switch across, they have their direct debits there. You've got to pay in a minimum of £1,500, and you have to make 20 debit card payments in the first 60 days, as well as log in to the HSBC mobile banking app and deposit a minimum of £50 into a new online bonus saver account within those 60 days. So HSBC are trying to make sure you are making this now an account that is being used regularly. That's what the debit card payments are trying to make you do, but also to save. And if you then do that, you will receive £100. If you then do the same things every month thereafter, so you need to put in £50 a month into the online bonus saver account, you've got to do 20 debit card payments at least, and put £1,500 into the account every month. You will get an additional £10 paid into that new HSBC account. It doesn't matter if you miss a month, you don't fulfill that criteria. If you do that for 12 months in a row, you'd get an extra £120, which add that to the initial 100, that's why we get £220. If you miss a month, it doesn't matter, you can pick up the trail the following month, so you can get up to the additional £120. Now, this isn't an advert for HSBC. Why I wanted to talk about it is that we're seeing a movement that is probably going to continue, where they're going to put more and more stringent criteria that are trying to make you use the accounts and also take out additional products. So people like the gentleman who gave us the glowing review at the beginning of the podcast need to bear that in mind when they're sitting there planning whether they're going to use these different types of offer and build that into it. Now, I've mentioned earlier that the old account will be closed, and it's one of the reasons why I always have to caveat that if you look at old accounts, you might go, I've got that old account, I could effectively do this and get £220 over the course of 1 year. When you close the old account, if it's one that you've had for a long time, that will be negative for your credit report, because the longer you've been with the bank, that's a positive for any credit report. So if you then close it, that will be a negative. So it's something you don't really want to be doing if you're going to be applying for credit, for example, a mortgage. And generally speaking anyway, keep opening up accounts is a bad idea, especially if they have an overdraft associated where there's a hard credit search on your file ahead of things like a mortgage application. So bear that in mind. The bonuses are obviously attractive to some people, but there are drawbacks to keep chopping and changing, but there are lots of people who do open up new accounts and do this. So one thing I would point out, though, that if people are thinking about doing this in the future, then it may be worth opening up perhaps an account with a non-high street bank, because lots of these deals, that one at the moment, Lloyds, NatWest is another company that has got an offer out there. Lots of high street banks end up offering these deals. So if you open up current accounts with maybe some other places and you can use that to switch across from, then you might be able to take advantage of these offers without closing an account you do really want to keep open, because it's good for your credit report.
Yeah, and so those non-high street banks that you mention are the likes of Starling and Monzo, and even potentially Chase as well. And actually, while we're talking of Chase, there was quite a big announcement that happened this week in terms of the changes to the cashback you can earn with Chase. Now, Chase came to the UK market in around about 2022 with a bit of fanfare, to be honest, because of their very lucrative cashback. Initially, it came to market where people could open a Chase account and earn unlimited cashback. Now, as they've now penetrated this UK market, they've kind of changed the terms as the years have gone on. To be honest, it's still decent, but you will find that after 12 months of being with Chase, there will be extra conditions put onto your account. There'll be a limit to the amount of cashback you can earn each month. That's £15 currently. And there was a minimum amount that you needed to put into that account each month, which was brought in last year. That was £500. Well, going forward, existing customers that have been with them for more than a year now will be moved over to a different type of cashback offer, which will mean that they have to put in at least £1,500 every month to qualify for that cashback. So I'm just bringing it to the podcast just to mention, if you were thinking about Chase, or if you're already a Chase customer, changes are afoot. It's fine. It's still
you can still earn cashback on your everyday spending with a debit card.
Absolutely. And for new customers, there aren't these same caveats that are being placed on there. So if you're thinking about it, get in now, because these things do change.
Yeah, and we'll put a link in the notes of the podcast as well to our review of Chase, because it, like I said, it's been quite popular. One of the things I think that really captured the imagination was the fact that you didn't have to pay fees on overseas transactions, so when people were using it abroad. But of course that's changed massively. You have the likes of Starling and Monzo, but you also have a lot of high street banks that have wiped those charges. So for example, First Direct have actually removed those charges as well. So if you're listening to this podcast, do check whether your own current account now charges for overseas transaction and spending, because there's a very good chance that they don't, because lots of them have started to remove that. So it's something to bear in mind. But let's be honest, lots of people would probably prefer to use an account that they put their money in separately from their own current account if they go on holiday for safety reasons as well. So Andy, I think that's it. I think we are done. We've covered quite a lot in the podcast this week.
And we've even mentioned about reviewing the podcast earlier on in the podcast, like we promised to do week on week.
We say we're going to do every week. Please do leave a review. I'm going to say out there, the first person to leave a review on the podcast will get a Money to the Masses mug. I've still got a list of people I've got to send them to. Apologies. But when you leave a review, of course, it does take a while to filter, so you won't know that you're the first. So that's why, even if you do see one, do put a review in there as well, because it does make us happy. So that's it for this week on the podcast. As ever, please do follow us on socials. Instagram is a personal favourite of mine, but also subscribe to our newsletter, moneytothemasses.com/newsletter. Join our Facebook group, facebook.com/groups/money to the masses. And of course, do subscribe to our YouTube channel. I mentioned in a piece on the podcast that I do very timely pieces on that particular medium. Like this week I did the switching deal, but I also talked about the best fixed rate mortgages at the moment. And just to give you a quick insight, mortgage rates, fixed deals are creeping up slightly. We're up about 0.2% from where they were a month ago. It's still better than it was at the turn of the year, but the rates are slowly creeping up.
Yeah, and just to mention that you might see in the podcast notes a header that says support the show with a couple of links in there. We're basically putting that in now so that people can see that nice and easily, people who want to support the show. For instance, this week in there'll be some links to pension transfer cashback deals and also ISA cashback deals. And also there's a jam donut cashback app. All about the cashback at the moment.
Yeah.
We're putting those nice and easy to see in the podcast notes.
Fantastic. So all that's left for us to do is say until next time.
Until next time.